Well, U.S. and Iranian negotiators are heading to Doha as the peace deal narrative continues to evolve. To unpack what we're seeing on a global level and how that's feeding into sentiment locally, I'm joined by Zach Rios from Banyan Tree Investment Management. Zach, nice to see you this morning.
Good morning.
Look, the road to peace in the Middle East has never been smooth. And we're finding we've got this on-off tit-for-tat happening between the U.S. and Iran. Markets are seemingly pricing in resolution. Is that wishful thinking?
Look, the issue with the Middle East is, as you've hit it on the nail, there's very different religious, philosophical, different ways of different political systems. It's really a smorgasbord of different things that are combining together. So it is difficult. And then you've obviously got the overlay of US and its own strategic interests. So getting a peace in the Middle East is going to be difficult, but I think we're at an inflection point. I think we're at an inflection point because up until this point, there was just the threats of attacks on Iran. We're going to take you out. We know we haven't got a resolution there. And long story short, we've just realized that A, we won't be able to get a resolution there. B, the outcomes for a full all-out kinetic war is going to be catastrophic. And OECD recently published, I think visually, some numbers that should, but pretty much what Donald Trump said at the start of last week when everyone was pushing back on this deal. Oh, you're giving them $300 billion rebuild, unfreezing notes. I mean, this basically explains to you, look, forget about the actual numbers, but directionally, the orange line and the blue line. One's telling you, look, if this is a time-limited disruption of this Middle East issue, which I suspect we're going through right now, it's very much manageable, which is why I think, to your point, markets are saying, look, there's a resolution going to happen, and by all sort of noise that's coming out, they are trying to get to a resolution, but the prolonged, and I think Donald Trump said it as well, he said, if I don't make a deal, which is funny because he went into this uninvited, it will be catastrophic. And you can see the blue line from a GDP growth perspective, and on the right, the inflation line. And now we all know this, but I think this is just brings it out visually that what Donald Trump is saying. If he doesn't get a deal done, and he knows he cannot bring about a resolution from a all-out war perspective, this will be catastrophic for the global economy.
Okay, so based on that, you think it's fair that markets are pricing in some sort of a resolution in the coming weeks.
Yeah.
But that's not all investors and investor sentiment is contending with right now, because there's a very rapidly changing interest rate environment as well. Not just in the US, where we're now considering hikes if that inflationary picture pans out, but here in Australia as well, we're now talking about a hold, potentially peak rates. What does that do for your sentiment?
Look, I think at the start of this year, we were very much in the camp of rates had to go high in the US, which everyone's now flipped their expectations to, and even in Australia. And Australia was a little bit easier because the reason why it was a bit easier, because we think some of the emerging market central banks and even the RBA are a little bit front in terms of, we'll take a front lead in terms of trying to arrest the issues around inflation. So they reversed last year's cuts. But now that the market has obviously priced in potential further hikes, along with the ones we've already had, everything that's happened since the budget, the consumer sentiment, not just from Australia, but like you said, from the changes to the capital gains tax and other measures in Australia, it's really taken an impact. And you're starting to see that in the auction numbers. They're back to Sydney and Melbourne, your key markets are back to like 2020 level, COVID levels.
Yeah.
That's something they will have to heed some sort of attention to. So I think the market is expecting first rate cut for the RBA next year. We think they stay on hold. We don't think, and if a resolution happens, you see how quickly oil prices drop, right? So you start to get that normalization, and I think you could see potentially the RBA cutting before the market expects it to cut, which will be positive for the Australian economy, which will obviously be positive for risk assets, but it will be positive for some of these sectors as well.
Yeah, well, so yesterday Citi put out a note on the REIT sector, again, based on this premise that we could have hit peak rates. They actually named some of the house builders, because of course we're still in supply deficit, being I think Mirvac, but Stockland was its preferred pick because of its data center exposure as well. What do you make of all that?
Well, again, we want to be a little bit pure with our exposures. And look, I know the data center theme is very good. I mean, Goodman Group, right? 30% of your Australian property ETF is actually essentially driven by data centers. So, but I totally agree. The way we've been playing REIT is kind of having our cake and eat it too. We like the turnaround story in the US. So James Hardie's been our preferred pick. If you look at the James Hardie price, since the start of this year, has really recovered.
Yeah, and last week as well. I think it's Friday.
And the earnings have started to come through. And now, so James Hardie obviously has a much smaller exposure to Australia, about 20% of the earnings, more bigger exposure to the US. But yeah, Mirvac and the Stocklands of the world. But the area that we prefer a little bit more is retail malls.
Is that because you also see consumer sentiment improving, or what is that down to?
Look, the number one reason behind that is I think because since COVID, the whole narrative around where everyone's going to be at home, no one's going to be visiting, I think that whole story has played out and we've seen it in the numbers. But what we're starting to see, and I think this is a very important data point, it actually just landed on our table last week, but this is a thematic we've been talking about for the last 6 months because vicinity centers, the center groups, they've been talking about it. Simple story is supply was increasing at 2 to 3% per annum from 2010. This is retail mall, right? Now, basically, since COVID, absolutely, people's way of spending, people's way of experiencing things has changed. New supply is pretty much non-existent. That means the existing high quality malls, and I can tell you every time I go to malls in Queensland, in Sydney, they are packed. People aren't shopping from home. Yes, they are, but they still want to be out experiencing. So the malls have refurbished their properties to cater for the more experienced restaurants and whatnot, and you're getting no new supply to come on. I can tell you, I always go, whenever I see someone closing up shop at a mall, I always ask them, more likely than not, they tell me there's a waiting list of people trying to get in, and the operators are saying, the landlord is saying, unless you increase the rent, this is where the positive leasing spreads are now starting to come through. And we saw that last year as well. We've got a bunch of people to come through. And so the retail stores that are being pushed out, they are not struggling. This is the funny thing. They're not struggling. It's just that the demand is there for high foot traffic retail because no new retail is coming through. And we think you're getting half decent yield. You're getting, so like one REIT manager put it to me, you're now getting a structural and a cyclical uptick. So this is a asset allocation that we are expressing both in our multi-asset strategy and our bottom-up strategies.
So you are expecting good things from Center Group and Vicinity come reporting season?
Yeah, that they're our preferred play. Again, stick to high-quality malls, and globally industrial as well. In Goodman Group, we own Goodman, so that gives you the data center, but obviously the industrial exposure as well. But these are the ones that we feel will benefit. And look, they have started to turn around already. So, but we think stick to high-quality malls where they can start to really churn the net operating income growth.